Hello, my name is Paul Wallace. I'm the Africa editor of The Banker magazine, and I'm here with Diana Layfield, the CEO of the Africa region for Standard Chartered. Diana, thank you very much for joining us. I'd just like to ask you first about Standard Chartered's plans for Africa in the next few years.
Well, as you probably know, we are expansive both about and in Africa. It's one of the key regions for the bank, and we see it becoming more important. Our clients globally continually ask us questions about investing in Africa, and the trade links between Africa and Asia in particular are building every day. Specifically, I think we've already said that we would look to, as of the beginning of last year, look to try and double the business over 5 years, and that includes both opening new branches within Africa, but also building our core wholesale banking business and deep sectoral expertise in the continent.
You recently got a full banking license for Angola. Are there any other countries that you hope to enter in say, the next 2 years?
I think we are looking thoughtfully at a couple of different markets. We are having discussions with the Mozambicans, as you know, about potentially opening in Mozambique. I think in due course, as that market opens up, we would be interested in Ethiopia. But beyond that, quite frankly, we already have 16 markets in Africa which are showing enormous promise and growth. And so in order to focus on investing in those, we need to be thoughtful about over-expanding.
When Standard Chartered looks to double its Africa business, how does it envisage the split between retail and corporate banking? Which one will sort of play a bigger role in terms of your business on the continent?
Well, we see both as being a core part of our business. That's been true historically, and I think under both the new regulations, whether it be Basel III or future regulation, we believe it's even more important to have both parts of our business. We see them as genuinely synergistic, and we've actually spent some time reorganizing the group around getting closer collaboration between our retail and wholesale banking operations. So I think both are key. At the moment, as you know, in line with the group, wholesale is a larger part of our business. And I think for a number of years that will continue to be the case. But we are very focused on investing in the retail segment in Africa as well. And clearly, given the shape of the population, the demographics, that's likely to be an important and growing market. So I think the answer to your question is both.
You have quite big subsidiaries in places like Ghana, in places like Kenya. Are you going to expand your branch network in those places? Is that part of your plans?
Absolutely, yes. So we are looking to expand our branch network, particularly in the larger cities. Typically, the clients that we bank on the retail side tend to be more urban than rural in nature. That's partly to do with the type of coverage we can offer versus local banks, and partly to do with the type of services we provide and what they need. I think the thing to stress, though, is that the concept of what a branch is and what a physical presence looks like is changing rapidly in Africa. And this is a region which is actually leading the world in thinking about mobile banking. And so for us, it's very important to think about hybrid outlets. We have a very interesting branch in Kenya, which has almost no people. It's essentially an electronic branch. It's called Breeze at the Junction at one of the largest shopping malls in Nairobi. So I think the answer is yes, we will have more branches, but we need to think about what shape they take and very carefully where those should be located.
In many African countries, the banking sector is very profitable, and you get a lot of big banks making returns on equity of over 20% on a routine basis. Do you think those sorts of profitability ratios are sustainable for quite a while, or do you think as Africa's banking sectors mature that those types of returns are going to be harder to make?
Well, again, I think the answer to your question is both to some degree. I think you are seeing, I think it's a very positive thing, increased competition across the board in African banking. You're seeing the emergence of very strong regional banks, but also stronger and stronger local banks, rather as you did in Asia 20, 25 years ago. And I think that's a good thing for the market. It's a good thing for the local economies, not least because those institutions all provide different but complementary offerings in terms of what the population need for banking. So I think that will bring pricing in and it will create genuine, stronger underlying competition. But on the returns point, the only thing I'd caution again, people tend to look at snapshot returns. They look at 1 year or another year or a couple of years together. What you have to look at is total returns through the cycle. And actually, if you look at the continent as a whole, there are a large number of banks that have suffered very difficult years. There are often quite substantial losses within the sector. So I think it's very easy to look at the headline returns on equity and say, this is egregious. But it obviously depends, on what the equity base looks like, and when it was valued, but also what the actual total return over a longer period of time looks like.
One of the things that Standard Chartered has got involved with recently is the Power Africa initiative. I was just wondering if you could explain briefly what that is, what it hopes to achieve, and also what it entails for Standard Chartered.
I think it's a hugely exciting initiative. It was obviously announced in June last year by President Obama. In very short form, it's a commitment of $7 billion of US financing capacity, US government financing, government-backed financing capacity, and $9 billion of private sector financing. What it does that I think is exciting and unusual is it brings together the regulatory, the economic, and the policy frameworks around power in Africa for the first time. And it isn't a panacea, but I think it is a very, very good way of bringing together all those constituencies and focusing on what we need to do to change the speed and the effectiveness with power rollout in the continent. Very specifically, it's providing electricity to very large numbers of people who didn't previously have electrification. Our role is as the largest private sector participant. We've committed over $2 billion in financing over a 5-year period, and I'm pleased to say that is well ahead of track at the moment. So we have no doubts that we will reach that target, and we hope to reach it significantly shorter than 5 years. You probably saw a couple of weeks ago at the WEF we announced Azura Power, a very substantial gas power station in Nigeria. That's our second large project in Nigeria in a relatively short space of time, and we have projects across the rest of the key countries and frankly across countries in Africa beyond the initial Power Africa remit. So I think what it does is it brings money, documentation and policy framework together.
Dana, thank you very much for your time.